Americans wondering what it means for our money.
And that's why we asked Brad Huffman to come in today to give us a little advice and to test our knowledge about how to react to some of these market changes. Good morning again. Welcome back.
Good morning.
So we need to talk about three areas because early, middle, and late career are different types of planning.
Correct.
So let's start with early on. Let's say you're a young person, you're just getting into the workforce. We're not even thinking about retirement at that point.
That's true. Hopefully you are planning for it. So starting the 401k, starting the retirement, but generally you're talking about people at least 20 or more years from retirement. So their first and most important goal is to establish themselves in their careers. But one of the things in the back of their mind, if they're paying attention, they're putting stuff into their retirement plan, is they're saving, they've got money now, they're accumulating assets probably for the first time in their lives. So if they're watching what's going on in the financial media, if they're getting their statements, we had a pretty rough week last week, and we haven't been accustomed to that in the past year and a half. So it's gotten people's attention. But for these young people, risk is not a bad thing. In fact, risk is what will help them create wealth over their careers. So for the most part, they're in the early stages. So for the most part, right now anyway, we're not sure where this is going to go yet. So from that perspective, knowing the young people, what do you think we should be doing? Should we?
But the bottom line is, if you have 20 years from here to there, you've got time for it to recover then.
Right, that's it.
We're going to
hold steady.
Yeah,
it's really a no-brainer. I think what I see the biggest mistake is young people get panicked. And they think, oh my gosh, it's the end of the world, I'm going to move. When in fact, they generally are much better served staying with it. The risk is good. They're putting new money in every week, every month, whatever the case may be. So the farther things go down, that's not necessarily a bad thing for them because they have the time and they've got plenty of opportunities to exploit the volatility over their careers. So
now what happens if we're not talking early in your career, but mid-career, you know, maybe where we are right now? What should we be thinking?
Mid-career, maybe 10 to 20 years from retirement. Generally, we'll have some assets accumulated, certainly more net worth at risk than the young group. So they're going to feel it a little bit more. Last week's bump is going to be visible on statements that are coming out this week. So these people, are going to be a little bit more anxious. However, they still have a lot of time. When you consider a 10, 20 year time horizon, generally speaking, risk is not going to hurt you all that much over that time period. In fact, it should help you create wealth. And again, back to the time factor is there's time to recover.
So still, we need to hold steady?
Hold steady, yeah. I would say unless you're losing sleep at night, maybe you do want to trim a little bit off the top. But for the most part, these people in mid-career, they've got a long way to go. And again, unless you have a specific risk management strategy, if your thing is just to sell and stay there forever, that's going to hurt you over the long run. So you have to have a plan, but at the same time, generally speaking anyway, those people should be in pretty good shape.
Generally, things over the long haul tend to grow,
that's the secret.
That'll get you there.
Yeah.
All right, so you're maybe 5 years away from retirement. Now we're late in our careers, and now risk is more of an issue.
That's correct. So when you reach that late career, or even when you're in retirement, you have probably accumulated your highest net worth. There will be a point in that time where you actually start drawing from that. So you have a lot of capital at risk, and you don't necessarily, and the most important part is you don't necessarily have that time frame that you did in early or mid-career. So when volatility emerges, it becomes very significant because you may, actually if you're in retirement, you may be using that money to live off of. So if you see a meaningful decline, and again, I don't know and I don't believe right now what we saw last week is going to turn into a 20–30% decline. I just don't see that happening.
This is a blip.
This is, I think, a short-term issue. I think there's a little bit more, but I don't see it being this massive decline. But still, that group at that stage does have to be a little bit more cautious because, again, they can't suffer. Even a 20% loss for someone a few years from retirement could be a very challenging event.
So your riskiest things you should get
out, I would say. And again, I would say get out with caution. So not necessarily liquidating everything. I don't see that. This isn't 2008, not in my view anyway. But maybe you trim, maybe a quarter. You take a little bit off the table. Certainly, I think from a liquidity perspective, if you are retired, whether it's a good market or bad market, you should always have enough cash to meet your expenses over the next year. So again, not necessarily run for the hills, but certainly protect your assets. If you have some great performing stocks that have done real well, maybe take a little bit off. It's never a shame to take gains. I'm always happy to take gains. I'd rather do that than to face losses down the road.
Well, Brad Huffman, thanks so much for joining us this morning.
Pleasure.
And Brad is sticking around in the Social Media Cafe. Stop by the Good Day Columbus Facebook page to get any financial questions answered.
Danger Will, Rob.